Morgan Stanley is a company that's done very well over the last 5 years. We can see it's up 160%. Maybe that doesn't scream crazy good to you. The S&P 500 is only up 90% over that time frame, but this isn't a crazy outperformance. But you have to factor in Morgan Stanley is a financial institution, and generally financial institutions don't do crazy good. They just don't. Look at the performance since 2009 when banks and financial institutions kind of got rocked for obvious reasons. They haven't done particularly well. They trade at much lower PE ratios. Even though the stock's up 160%, the PE ratio is still 19.5. That's pretty cheap. It's not cheap compared to its peers because this is where they trade at generally, somewhere between 10 to 20 the large financial institutions trade. But compared to the S&P 500, which is at about 27 right now, it is cheap PE-wise. Also, the dividend. It's more than double the S&P 500's right now, and it's been on a decent run. So it's generally closer to 3 times more, but right now it's 5 times more. But yeah, once you factor in a company that pays a dividend this high and has gone up this much, it has just been great. And it's been great over the last decade as well. Since late 2015, you're up from 35. You're outperforming the S&P 500 over the last decade as well. S&P 500 is only up about 200%, but it's even more so when you factor in dividends because this is a stock that's going to beat the S&P 500 dividends. Not, okay, we have to factor in the S&P 500 does more. And you may be questioning why I talk about S&P 500 so much. It's just a benchmark. It's a general benchmark of, okay, this is how the broader market is performing. Now we can see for PE, or PE's 19, a little over 19 for PEs, about 17 and a half. That's pretty good. Generally, they've beat 3 of the last 4 and pretty dramatically. They had 1 miss, but not crazy significant. So we're looking at growth. Let's look a little bit at the history of the growth. Yeah, earnings per share has dropped a little bit. Revenue's up as projected. You get a lot of volatility with banks specifically, and a lot of it is looking forward to the Trump administration. I'm not going to talk politics here, but generally it's associated that Republicans are a little bit more lenient with financial institutions in terms of regulation, and that helps them boost their profits. Whether that's realized or not, I'm not going to say, but that's the perception. And that's at least why you've had a decent run since November, right? The election. I mean, it was on a little bit beforehand, but even then, since then, it's been even more dramatic. So if you want to take a look at that, but I assume all you know what Morgan Stanley does, primarily investment, financial products, that sort of stuff. Wealth management's their big thing. They do other stuff as well. Most of these large financial institutions do. They're a very large company, $200 billion. I like them. I've talked about them on this channel before and said I liked them a couple of months ago before they've been on this run, right? It's been up there. Not quite because this is the last 6 months, but it's still up before then. The issue is not a lot of people watch those videos because that was a brand new channel, so they only got a handful of views. So probably none of you watching remember that, but I have talked about Morgan Stanley many times. I'm a large fan. I've owned them. I've done well. It helps the perception of the company when I've owned them and done well on them. I'll tell you that much. It really helps me have a positive outlook, but I'm not the only one. Schwab still thinks it's going to do good. They reiterated 6 days ago they think it's going to be the top 11% of stocks performing over the next year. That seems high to me, even as someone who likes the company. I like this as a long-term hold. The dividend will be good, even if the share price retracts a little bit. But apparently, Schwab doesn't think it will. They think it's going to do very, very good. I can see it continuing to do good, and I hope it does. But even if it didn't, I wouldn't mind collecting that dividend in the meantime. But apparently, Schwab thinks it's going to do. Don't get me wrong. I think in the long term, this company is going to do good. In the short term, I don't know. I'm not really smart enough to predict 1 year out. I look, 2, 3, 4, 5 years out, this company should do good. And I hope they will. I think they will. But Schwab thinks short term, I think it's a 1 year outlook. They think it's top 11% of all stocks performing in the next year. That is a very, very good rating. They think it's going to do very well. You got narrow there, 2 stars, 3, 4 buy, long. And I hate this rating where they do like a 0, 3, 10, right? None, narrow, wide. I'd give it more of like a 6 or a 7. They're very large. People know about them. That's, in my opinion, that's a pretty decent economic moat. There is competition. There's quite a bit of competition. So I think that's why it's narrow. But I think that's not capturing the full picture of it. They do ESG. If you want to take a look at that. Dividend. It's grown dramatically. It's grown exponentially, right? 29, 22, 18, 8, 50, 40, 10. Then this year we're looking even higher still. Not quite as high, but you're getting incredible hikes on the dividends, and it's compounding. So you can probably expect the dividend to get better and better. We're done looking at Schwab. Let's take a little bit of a look of the historical PE. Right, you got 19. So we're a little bit high, but like I said, it's been on a really good run. Even as much as a year and a half ago, it was at 11. Now you're at 16. So you're a bit higher, but people are pricing it at, hey, this company's doing good, it's done good. A lot of people saying hold. This isn't too unsurprising. Many companies do say that, especially when they aren't growth oriented. Usually you get about half buy ratings. This is clearly under that. Only about 5 of the 22 analysts are saying buy. The rest are saying hold, but you often get that for companies like this, especially when it's not growth, not in tech. People don't want to go out on a limb and say buy. Schwab is, so you may factor that in. Like I said, I don't think this is a crazy, oh, you have to buy right now either, but it may be a company you should consider over the long term if you want to hold, if you like good dividends. So I guarantee you there will be a time where they pay above a 2.9% dividend. I almost would guarantee it, because they're trying to increase that more and more, and this stock is decently high right now, where even if it runs sideways or goes up a little bit, earnings might outpace that, dividend might outpace that. But I like this stock. I like it as a long-term hold. I own it as a long-term hold. I've done very well. Is it like screaming by at this price? Maybe not, but having good companies is never a bad thing. Of course, not financial advice. I don't give investment advice. It's just hopefully to educate you and provide my insight to the company. If you enjoyed, I appreciate if you left a like or subscribe. It means a lot to me, but I'll catch you in the next video. Thanks for watching.